Hello everyone and welcome back to my channel. In the context of fixed income securities and bond valuation, in this class we are going to learn something very important, different type of bond yields which are relevant to money market instruments. Now you would have come across different types of bond yields, and we have discussed these different types of bond yields in the earlier classes as well. Just for me to remind you, it could be yield to maturity, yield to call, yield to worst, and we have even learned current yield. But what I am going to do, certain bond yields which are not just relevant for the bond market but relevant for money market, we are going to deal with that today. So I'm sure you people understand difference between the bond market and money market. Bond generally comes as a little long-term instrument. It could be a mid-term instrument or a long-term instrument, but definitely having its maturity for more than a year definitely. Okay. Instruments which are having shorter maturity, that means maturity less than a year, are basically classified as money market instruments. T-bills, what we generally use as short name for treasury bills, CPs, that is commercial papers, then certain type of bank deposits, all these are considered as money market instruments. Now the conventions used in money market and conventions used in bond market are little different, and that is where on a comparative basis you should be aware of which kind of convention to apply in which market. So what I am going to do in this class, we are going to discuss first of all what is current yield. Current yield is a very simple concept. In fact, I remember I have discussed this in your classes earlier, but anyway we are going to talk about current yield as well in this class. Add-on yield, this is not something that we have discussed earlier because this is generally relevant to money market instruments. After add-on yield, we will also learn discount yield. Discount yield is typically used only in money market. And then comes bond equivalent yield. Now, generally, money market instruments, the kind of yield which is followed as a convention over there, it typically resembles discount yield. But from an investor's perspective, the way you compute the current yield of the bond, how would you want to assess the bond equivalent yield? That means had that instrument not been a money market instrument but a bond, then how would you determine the yield of the bond? So let me just focus on these two terms, because first two terms literally are very simple. The main connection that we will be sorting is between discount yield and bond equivalent yield. Let me set the context first so that when I give you notes and I take numerical examples, the discussion should be very easy going for you. So if I set the context, most cases in money market, instruments are traded at discount because the par value will be receivable on maturity. One typical example could be, say, discounting of bills, bill of exchange, and we trade in bill of exchange and the bill of exchange is traded at the discounted price. So what kind of scenario you would find? For example, say a bill of exchange having its par value as $1,000 is currently traded at $980. That means it is traded at 2% discount. How do you compute this 2% discount? This 2% discount is computed on the par value of the instrument. So par value of the instrument is the amount that you are going to receive on maturity, that is $1,000. But right now it is traded at $980. So it is traded at $20 discount, and $20 is basically 2% of $1,000. So the convention in the money market instrument goes in this format that we generally don't quote the yield based on the market price of that instrument today. We quote the yield as a discount yield. But if you understand this whole thing, current market price of that instrument is $980. on maturity, maybe after 3 months, you are going to get say $1,000. So the holding period yield over there, it is 2% on a discount yield basis. So, and as I said, 2% is computed on the par value. That is why the discount value or the discounted value is $980. But if you look into the investor's perspective from the bond market, investor would believe this way, that I am making an investment of $980 today. I am going to get back $1,000 after a certain period. So what is the rate of return on the money that I have invested? To compute that rate of return, $20, which will be the income of the investor or return of the investor, will be divided by the amount of investment made, that is $980. So it will be 20 divided by 980. So if I use the calculator, 20 divided by 980 would give you 2.04%. So what you get as 2.04% for that holding period, that is resembling the bond equivalent yield. So where the discount yield was 2%, the bond equivalent yield was 2.04%. Bond equivalent yield will generally be little higher as compared to the discount yield. So what do we understand? Market price of that instrument is $980. Par value of the instrument is $1,000. If you want to compute the discount yield, the difference between these two, that is $980 and $1,000 difference, is $20. So $20 will be the numerator. In the denominator, if you want to compute the discount yield, the denominator will be the par value, that is $1,000. And if you want to compute the bond equivalent yield, the denominator will be $980, that is the amount of investment made. So when we take the calculative examples, things will be much easier, and let us begin with our discussion on current yield in the first order. And as I said, current yield is something that is very, very simple. Now if I have to define what is current yield, very, very simple thing. I am buying a bond which is offering annual coupon payment. So whatever be the coupon payment that I am expecting to receive in the first year of purchase, that is the annual coupon payment, becomes the numerator. And what is the current market price of the bond, that I take as the denominator. That means annual coupon payment divided by the current market price, that is going to be the current yield of the bond. Matter ends. This doesn't take into account various factors. For example, it doesn't take into account what maturity value you are going to receive at the end, what will be capital gain or loss in terms of rise or fall in the value of the bond. Nothing is considered. So if you want to accommodate all those factors, do you know the yield that we consider is the yield to maturity. So yield that you are going to earn if you hold the bond till maturity is the YTM of the bond, that is yield to maturity. But currently what you are going to earn is indicated by current yield. And how do you measure that? As I said, the formula for current yield will be annual coupon payment divided by current market price of the bond, and it tells how much return you are currently going to receive based on whatever be the bond's price prevailing today, not on the basis of the face value of the bond. And of course it ignores the capital appreciation or capital deterioration over the period. For example, if the par value of the bond is $1,000 and right now it is traded at 1,020, correct? Possible? In that case, you are going to invest $1,020, but on maturity you will be receiving only $1,000 maybe after 5 years. That reduction in the value is not accommodated in the current yield. Current yield simply looks into how much money you are investing today, and in 1 year time what coupon payment you are going to receive. Based on that, what is your rate of return? That is the current yield. Now you would be wondering, why did I discuss current yield in this sequence? Because current yield actually has nothing to do with the money market instruments, correct? Current yield is generally computed for bond only. But related to current yield is add-on yield, and add-on yield is then connected with other yields. So that is why when gradually I take the matter ahead, you will be able to understand. But before we move ahead, let's quickly write down this important matter. Alright then, moving ahead from here, the next thing that we have to talk about is add-on yield. Now what exactly is add-on yield and where it is used? In most cases in money market, you deposit or invest your money for a shorter span, and that is where compounding of interest doesn't happen. So when the interest is computed on deposits or loan given or loan taken, how do you compute the interest? So it is a principal amount into rate of interest on a percentage basis into number of days that you have considered. So number of days that you consider. Now here there may be two different conventions. One is 30 and 360 days convention. When I say 30 and 360 days convention, what does that mean? It means that you are assuming that a month comprises of 30 days and a year comprises of 360 days. In that case, you are not going to count the actual number of days. For example, if you take a non-leap year like 2025, and if I say that compute the interest from January to March, so January, February, March, 3 months. So 3 months will be equivalent to 90 days, and number of days in the year will be considered as 360 days. So 90 by 360 will be the time factor that you adjust. That is the 30 days and 360 days convention. But actual to actual convention will not allow you to take 90 by 360. In that case, what you will do, you will take the actual number of days from January 1st till 31st March. So it will be 31 days in January. 2025 being a non-leap year, you will consider 28 days in February, and you will include 31 days of March. So 31 plus 28 plus 31 will again make it 90 days. But you are counting actual number of days. Earlier what I did, 3 months, so 3 months multiplied by 30 days. That is how I computed the numerator. But what happens over here, when you are taking actual to actual convention, for January to March, actual number of days also worked out as 90 days, but the denominator will not be 360 days now. The denominator will be 365 days. So the add-on yield follows the convention of either 30 and 360 days or actual to actual. It depends upon situations and scenarios. So this point you have to carefully note that which instrument and which yield is connected with what calculation, and how is that calculation connected with the number of days count, where you consider compulsorily 365 days in a year, and where you can alter anything between 360 days or 365 days. So I'm going to summarize that whole thing, but let me first give you some important notes over here under the heading add-on yield. Add-on yield is the annualized return on an investment calculated on the principal invested using simple interest. So it will be add-on yield equals to interest earned divided by principal invested into, as I said, you can follow either 360 days or 365 days, and divided by days to maturity. Keep in mind, if you are taking 360 days, then days to maturity may not be considered as actual days. You may continue to assume that there will be 30 days in a month, where you are taking 365 days in a year. You have to count the actual number of days to maturity in the denominator. It is used for instruments that pay interest on a simple interest basis. For example, certain deposits or loans, the interest is add-on to the principal and both are paid at maturity, often used in bank deposits and certain short-term investments. So quickly take note of this whole thing and then I take you ahead. Alright friends, once you have completed this, the next point in our discussion is discount yield. Now this was the main factor that I wanted to discuss actually. Discount yield. Here in this discussion, I am particularly focusing on connecting between two types of yields, discount yield and bond equivalent yield. Discount yield, which is relevant for money market instruments like treasury bills, commercial papers, and even bills of exchange. And we are going to apply the conversion of discount yield into bond equivalent yield. When we started the discussion, I gave you a small example, but we are going to take good number of examples, calculative examples, to have this understanding much clearer. So what exactly is discount yield? Discount yield measures the annualized return. Now understand, it measures the annualized return. You may compute HPY, that is holding period yield as well, but generally when I mention something as yield, whether it is current yield or discount yield or bond equivalent yield, one thing is always clear, that it is always stated on an annualized basis. So it is basically the annualized return on a discount security. What is the significance of writing this discount security? A security that will not give you any interest payment or coupon payment, a security that will give you the par value or the face value on maturity, but currently it is traded at discount. So initial example, if you can recollect, $1,000 commercial paper is currently traded at $980. So the holding period discount yield is 2%. How we computed 2%? That is $1,000, $980. The difference is $20 discount. The $20 discount divided by the par value, that is $1,000, gives you 2%. That 2% is basically the discount yield. Now, what is its connection with bond equivalent yield and how do we determine that? That is all we are going to learn. But if you have to compute discount yield, so many candidates, many students, they focus on this kind of formula. There is no harm in applying formula, but use your simple understanding. Now, based on what example I gave you about the market price being $980 and par value being $1,000, look at one thing. The face value will be $1,000, price is $980. So what are you taking in the numerator? That $20 discount, and the denominator is face value, means $1,000. So 20 by 1000 will give you the holding period yield as 2%. But you need to annualize it, and that is why you have to adjust for the number of days. Now here you have to be very, very alert. The moment you see the yield as discount yield, it follows the convention of money market, which compulsorily considers 360 days in a year. Compulsorily considered 360 days in a year as the convention. As a result, in the denominator there will be actual number of days. Even though in the denominator you are taking actual number of days, in the numerator you will always take 360 days. And if you are asking me the reason why, it is basically the convention of money market instruments like T-bills and commercial papers, where you always take 360 days as the number of days in a year. Once you make this calculation, where it is used for short-term instruments issued at discount and there is no coupon payment, and yield is calculated on the face value, standardized over a 360 day year, means you are compulsorily considering a year as 360 days, and is popular for T-bill and money market instruments. So I would want you to take note of these important matters, and then we move ahead. Alright friends, once you have noted this whole thing, let us move ahead, and now we write something about bond equivalent yield. Now here I already told you, in that example of current price of the instrument being $980 and par value being $1,000, in that example, from the investor's perspective, what you are going to earn by investing today, what you will be earning in this holding period. You will invest $980 because the price of that instrument is $980. You won't get any coupon payment, but at the maturity you will be getting $1,000 par value. So today you invest $980. So logically, how do you compute your return or your yield? Logically, it is not a discount that you are computing, it is your yield that you are computing, the way you compute the current yield of the bond. Now recollect, how do you compute the current yield of the bond? In the denominator you take the actual market price or the prevailing market price, correct? Current market price is taken as the denominator. That is why I highlighted current yield concept at the beginning of this discussion. So current yield, the way it is computed, you are going to take only the coupon payment. Here there will be no coupon payment, that is why bond equivalent yield is little different. So you are going to take what you are going to earn from the current market price to the par value. In our example earlier, $980 is what you are investing now, and you'll be getting back $1,000. So your return value is $20. You want to express that return as an yield, you have to divide it by the money that you are investing today. Money that you are investing today is $980. So if you are investing $980 today, it will be $20 divided by $980. You can multiply by 100 to express the result in percentage. But when you are doing this, it will not give you the annualized yield, it will give you the holding period yield. To compute the annualized yield, you will have to again consider the time factor, that is the days remaining to maturity. But here you need to again understand one thing: bond equivalent yield is referring to bond market, and in bond market we don't assume 360 days in a year. So in a bond market, the number of days in a year will always be considered as 365 days. As a result, when you are computing bond equivalent yield, you are going to use 365 days in a year. And second thing that you need to understand, BEY or bond equivalent yield will be the difference between face value and the price. So face value in my example was $1,000, current price was $980. So that difference will be $20, but it will be divided by the amount of money that you are investing now, that is $980. That will be multiplied to 365 divided by days to maturity. And of course, if you want the result in percentage, you multiply by 100. Otherwise, you will be getting the yield in absolute terms. Now, bond equivalent yield, where it is being used. So generally for a money market instrument, where money market instrument will be quoted at the discount yield, from the investor's objective or from the investor's perspective, if you want to find what would be the equivalent bond yield or bond equivalent yield, why are you computing this, by the way? Because when you say that if I invest into this bond, my current yield is going to be this much. If I invest into this instrument, what will be the yield? But the quoted yield in the money market is not the bond based yield or bond equivalent yield. Quoted yield in the money market is the discount yield. As a result, you want to convert the discount yield into bond equivalent yield so that you can actually compare with similar kind of bonds and what yield you will be getting in bond actually. So bond actual yield for a shorter period like will be current yield. On the other side, for that money market instrument where discount yield was quoted, which you cannot directly compare with a bond yield, so you convert a discount yield into bond equivalent yield, and the bond equivalent yield can then be compared with other types of yields of other instruments which are actually bonds, and then you can decide which instrument you should invest into. That is why this yield is not for bonds, it is computed for money market instrument, but in the style that is relevant for bonds. That is why it is called bond equivalent yield. Because it follows the bond market criteria, the number of days that you should consider will be 365 days. So if there is any money market instrument which has one entire year as maturity, because it is one entire year, this factor you don't have to then consider because it is one entire year. In that case, whether it is discount yield or bond equivalent yield, you are not going to consider 360 or even 365 days because this whole factor will be ignored. That time you just have to take care of one thing, that if you are computing bond equivalent yield, the denominator will be the current market price because it is computed based on the money that you are investing today, and if it is a discount yield, you are going to consider the denominator as the par value of the instrument. All these matters you need to consider, and what I'll do is initially I'll take examples where I take 1 year maturity period where 360 or 365 days doesn't come into picture, so that your base concept gets completely clear. Then what I'll do is I'll take up examples where the maturity period will be say some 45 days or 60 days or 30 days, something like that, where we will be using these conventions of number of days as and when required, and whichever yield you are computing based on that, what is the relevant number of days that you should consider, we are going to apply all that. But before I move to that part, let me give you an opportunity to take note of this whole thing quickly. Alright friends, once you have completed this much, let us move ahead, and next thing in the discussion, I am just giving you a summary of what are the yield type and where it is typically used for. Current yield, it is typically used for mid-term or long-term coupon-bearing bonds. Add-on yield is generally used for or typically used for short-term money market deposits and simple interest instruments. Discount yield necessarily used for money market discount instruments like T-bills, which can be treasury bills, or CPs, that refers to commercial papers. And bond equivalent yield, most important thing is the utility of this term. The utility of this yield, it is used to express yield of a discount instrument. So it is basically a discount instrument, which is a money market instrument. You are considering the discount instrument but trying to express its yield in bond equivalent terms. That is having the objective of to make them comparable with bonds. So quickly take note of this table as well, and then I take you ahead. Alright friends, once you have written this, let us start dealing with examples. The first example in this sequence, current market price is rupees 800, face value is rupees 1000, remaining maturity is 1 year. Now this is the basic data given to you, and if I ask you to compute the discount yield of this instrument or bond equivalent yield of this instrument, how logically you will compute it? So understand one thing, the face value of the instrument is rupees 1000. It is currently traded at rupees 800. So if we talk about discount, you have to always look into what is the par value. Compared to par value, it is traded at a discount of rupees 200, correct? 1000 is the par value or face value, 800 is the price. It is traded at 200 rupees discount. So in the numerator you will take 200, and when I say discount, it is connected with the par value. So the discount yield, if you have to compute, it is 200 divided by 1000. That will give you what? 20%. In the same scenario, if I have to compute the bond equivalent yield, then it will not be computed that way. Bond equivalent yield is computed little differently. There the objective of the investor is little different. How? Investor believes this way, that I am investing rupees 800 now and I am going to get back rupees 1000 after 1 year. That means what I am earning is 200 rupees by investing 800 rupees. So my rate of return or my yield is 200 divided by 800. Can you see the difference in the perception when it is a discount instrument and quoted as a discount yield, and when it is that you want to find the bond equivalent yield of that instrument, so that you can compare that with other bonds in terms of what will be more lucrative investment for you. So how would you express the calculations over here? If it is a discount yield 1 year, how would you compute that? 1000 minus 800, that difference you divided by the par value, that is 1000, the result will be 0.20 or 20%. Same thing if you want to compute in terms of bond equivalent yield for 1 year, it will be the numerator remaining same, 1000 minus 800, that is 200 is what you are going to earn in this period of 1 year by investing how much today? Rupees 800 you are investing today, and your bond equivalent yield will be 25%. Now in money market instrument, this is never going to happen in reality, that you invest 800 and in 1 year time you get back 1000. I purposely took this gap so that you can understand how the calculations are differing. If I take very close value, then this and this percentage difference will be very minimal and you will not see the impact of what is the calculation effect. But here it is much clearly observed when you are taking a substantial gap between the par value and the current price. So let me give you an opportunity for you to take note of this example 1 and then we move ahead. Alright friends, once you have completed this example, let us move on to the next example. That will be example number 2. Face value of the instrument is rupees 1000, remaining maturity is 1 year, discount yield is given to you as 10%, determine bond equivalent yield, that is the requirement. Now what you are going to do to answer this question, how you are going to approach? Very simple. Good thing about this instrument is it has 1 year maturity. So number of days adjustment and number of days remaining to maturity and what convention you need to follow, 360 or 365, you don't have to enter into all that. So things become very simple when 1 year is the maturity period. So simple logic, 1000 rupee is the face value and 10% is the discount yield for 1 year. So bond or that instrument is currently traded at a discount of 10%, means it is traded at rupees 900. End of the matter. You came to know what is the market price, 900. If you invest 900 today, after 1 year you will be getting back 1000 rupees. So you are going to earn a return of 100 rupees by investing 900 today. So what is your rate of return on the money that you are investing today, which in other terms we refer to as the bond equivalent yield. So the bond equivalent yield, if you have to compute, the numerator will be 100 rupees, denominator will be 900 rupees that you are investing today. So 100 divided by 900 into 100 if you want to express the result in percentage form. So let me put forward this example. You may take note of this example if you want, and once you have taken note of this example, I show you how to solve it. Let face value be F and current market price be P. So discount yield for 1 year will be F minus P divided by F. So discount yield is already given as 10%. On absolute basis, I'll write it as 0.10. I do not know what is the current price, so I write simply 1000 minus P divided by 1000. When I solve this equation, I find the value of P. It is very simple task. This equation solving wasn't actually needed because we could have directly arrived at the calculation. That okay, 1 year time period, $1000 par value instrument is traded at 10% discount yield. So the price of the instrument will be 10% discount over the face value. So face value minus 10%, that is 1000 minus 10% will give you 900. But I purposely wrote the formula and the calculation made as a formula based calculation because in reality you won't get instruments with a maturity of 1 year. The maturity will be in certain number of days where discount yield and bond equivalent yield will follow different conventions for considering total number of days within a year. That is where complications may come up. So I have taken this solution mode only for putting forward that matter. So bond equivalent yield, if you want to compute, that numerator value will be the return that you earn by investing 900. So if you compute 100 divided by 900 in terms of percentage, it will be 11.11%. On absolute basis it is 0.1111. So quickly take note of this calculation and then I take you ahead. Alright friends, once you have completed this, let us move on to the next example, that is example 3. Now what does this example convey to you? The face value of the instrument is rupees 1000, remaining maturity is 60 days and discount yield is given as 12%, and the question is asking you determine bond equivalent yield. Now the point over here is when you compute the discount yield, the gap between the price and the face value, you will be taking as the numerator, and in the denominator you must take the face value. The price is not given over here, but discount yield is given to you as 12%. That can be written in absolute form as 0.12. And through this information they have asked you to compute the bond equivalent yield, just like the previous example. But previous example was simple example because the period of maturity was 1 year. So number of days adjustments were not needed. Here you cannot do like that. Here number of days adjustment will be needed, and that is where you have to make sure that these yields which are mentioned over here as 12%, it is implied that it is annualized yield unless stated otherwise. Sometimes the example may state that it is holding period yield, then it's a different matter. Then it will be considered as yield for 60 days because it is given as HPY, that is holding period yield, or HPR, holding period return. But here when nothing given, it is implied that this will be annualized. and that is where the time adjustment needs to be coming into picture. And that is where, when you are dealing with discount yield, not to forget, you are going to take 360 days as the number of days in a year, and when you compute bond equivalent yield, you must consider 365 days. Now what I am stating forward are the real life calculations. So sometimes in CA exams particularly, when suggested answers are released, they keep a mess between 360 and 365 days, and that is where students get confused. I want you to be 100% clear over here. If it is discount yield, it is always based on 360-day year period, and if it is bond equivalent yield, it is always computed considering 365 days in a year. This is the point that you have to drill into your minds. There is absolutely no way that anyone can differ from this convention. And if you want to check yourself, make searches on your own. On the web, you will be finding more than 200 pages, different websites where the financial concepts like discount yield and bond equivalent yield are explained, and you will find everywhere what is given is matching with what I am conveying to you. So don't blindly follow the suggested answer of institutes. You just understand one thing: what is the real life concept, apply that. So let us work on the solution for this example. As a part of solution to this example, how will you start? Let the current market price be P. So discount yield will be F minus P divided by F into the days adjustment will be 360 divided by days to maturity, for converting this into annualized discount yield. And that annualized discount yield is already informed to you in the question. Face value is also known, that is 1000 rupees. P is unknown, so we have to find the value of P, and days to maturity given as 60 days. So when I substitute the given values, the annualized discount yield is 0.12. 1000 minus P divided by 1000 is this factor, and 360 divided by days to maturity is basically 360 by 60. So 360 by 60 will give you absolute value, that is 6. And through this whole equation, there is only one missing variable that we need to find out, and that is P. So let us solve this equation. What do you get by solving this equation? 0.12 divided by 6 will be 1000 minus P divided by 1000. So basically 1000 minus P divided by 1000, this gives you 2%, because if annualized yield was 12%, that is annualized discount yield was 12%, the holding period yield will be based on the 60-day holding period compared to 360 days in a year. So obviously you are going to consider that 0.12 as discount yield, which is annualized. So for the holding period, it is just 2%. When you make this solution further, cross multiply 1000 rupees into 0.02 will be equal to 1000 minus P, correct? So this will be what? Rupees 20, which is equal to 1000 minus P. So value of P will be obviously rupees 980. So take note of this calculation, and then I take you ahead. Alright guys, if you have completed writing this much, let us move ahead and continue further. Bond equivalent yield at 12% discount yield, how will you compute? It will be F minus P divided by P into 100 into 365 divided by days to maturity, because you want to find the annualized yield. But the yield now is not a discount yield, it is going to be bond equivalent yield, where 12% was the discount yield. What will be the bond equivalent yield? That is what we have to find out. Now we have all the required inputs, and the calculation can be made in one go. So substitute the values. It will be 1000 minus 980 divided by 980 into 100 for percentage, and into 365 divided by 60 days remaining for maturity. The bond equivalent yield comes to 12.415%. So please take up this calculation as well, and then I take you ahead. Alright friends, once we have completed this whole thing, let us move ahead, and now we take up the next example, that is example number 4. Indeed a very important example. So for all CA and CMA students at final level, let me put forward this point. In your textbook This example 4 is given as question number 50. So you can just mark it that this is same question number 50. So let us first read this question. It says a bond is held for a period of 45 days. The current discount yield is 6% per annum. So the annualized discount yield is given as 6%. It is expected that current yield will increase by 200 basis points and the current market price will come down by rupees 2.50. So they have not given you complete information this time because price of the bond is missing, even the face value is missing, but at two different current yields, that is current discount yields, if you observe, there is a gap of 200 basis points. So obviously if the discount yield rises, the price of the bond will fall, correct? Because bond price has inverse relationship with the yield. You have learnt it already. But over here, when you are rising the discount yield by 200 basis points, the bond price will come down by rupees 2.50. With this information, you are supposed to determine the bond's face value. Now, whether the discount yield is 6% or if it rises by 200 basis, rising by 200 basis points means absolute 2%. So instead of 6%, the discount yield when it rises to 8%, the bond price will drop by rupees 2.5. That is the information conveyed to you. Fine. So first of all, the face value is missing and the bond price will not be one singular price now, because if you are considering the discount yield of 6%, the bond price will be different. If you are considering the discount yield of 8%, the bond price will be different. And based on both of those respective bond prices, you are going to compute bond equivalent yield. So bond equivalent yield will not be one singular calculation of bond equivalent yield. It will be when the discount yield was 6%, then what? And when the discount yield rises to 8%, then what? So we are going to show all these calculations. Now based on the knowledge that you have got from the earlier examples, if you connect this information, it doesn't seem to be complicated. You just need to present the solution in systematic manner. I'll guide you through the solution now. We'll say let the face value of the bond be P. And now we know that price will not be just one price, there will be two different prices. So we will assume let the price at 6% discount yield be P1 and let the price of the bond at 8% discount yield be P2. So we have two different prices, P1 and P2. So 6% discount yield, if you want to compute, this is the formula, F minus P divided by F, same formula, but we are now putting P1 when it is 6% discount yield, and the time adjustment factor will be 360 by 45. Keep in mind one thing, the moment in the left hand side of the equation you are finding the words discount yield, you should be clear in your mind that the number of days that you have to consider for annualization must be 360 days. There will be no exceptions to this. We are very clear about it. Now let us do the math. So the left hand side will be 0.06 resembling 6%. F minus P1 divided by F into 360 divided by 45 will give you absolute value as 8. Now solve this equation. You won't be able to get the final value in terms of either the face value or the P1 price because we have two missing variables. We will have to find two equations to find the value of these two variables, but we can easily do that because one side we have 6% discount yield information, another side we have 8% discount yield information. So for 8% we have considered the price of the bond as P2. So we'll have three variables which will be missing, that is F, P1 and P2. But with the given information we'll be able to connect whole thing, and there is one more piece of information given, that is the gap between P1 and P2 is going to be rupees 2.5, correct? The gap between P1 and P2 is going to be rupees 2.5, that is also given. Fine. So when we solve this equation, F minus P1 divided by F will be 0.06 divided by 8. When you take 0.06 divided by 8, what you get is 0.0075. So F minus P1 will be 0.0075 into F, and when you solve it, P1 value will be F minus 0.0075 F, and that will be 0.9925 F. So P1 value is expressed as 0.9925 of the face value. Now if face value is 100, the P1 price will be 99.25. If face value is 1000, it will be 992.5. If face value is just 1 rupee, the price is going to be 0.9925. So we don't know what is the face value as of now, but we have expressed P1 price in terms of the face value. We are going to link it with the second price, which is based on 8% discount yield, as P2 price. We'll connect P2 price with F, and then the third connection comes as price gap between P1 and P2, with which we will be able to find all the three missing variables. So let us first write up this much quickly. Alright friends, once you have completed this much, let us move ahead, and now we make similar calculation with 8% discount yield. I don't have to explain this to you separately. The calculation done in the same manner, only one thing changes. 8% discount yield will be connected with the different price, which is P2. So when we solve this equation in the same style, in the same manner, we will be getting not F value, not P2 value, but P2 value in terms of F value, and when you solve it, you can find that P2 is going to be F minus 0.01 F. So P2 value will be 0.99 F. Please write up this as well, and then I take you ahead. Alright friends, once you have completed writing this much, let us move ahead, and now we say, if the yield increases by 200 basis points, the price of the bond drops from P1 to P2. So P1 minus P2 will be actually 0.9925 F minus 0.99 F. Now here you need to be absolutely clear with one thing. P1 value, when it was expressed in terms of F, it was 0.9925 F. P2 value, when it was expressed in terms of F, P2 value was 0.99 F. Correct? So when you find this calculation, you will be getting 0.0025 F, but P1 minus P2, the drop in the price by monetary value is given to you as rupees 2.5. So let me substitute P1 minus P2 as 2.50, and the right hand side of the equation will be 0.0025 F. Now we are very clear that 0.0025 F is resembling rupees 2.5. So F value will be 2.5 divided by 0.0025. When you do the math, 2.5 divided by 0.0025, what you get is exactly 1000. So rupees 1000 will be the face value. The moment you get this, P1 and P2 are already expressed in terms of F. You can easily find out what will be P1 and what will be P2. Let me just put the screen in front of you so that you can take note of the calculations. So P1 value is 992.50, and similarly when we make computation of P2 value comes to rupees 990, making sure that P2 is 2.5 less than P1. So take note of these calculations, and then I take you ahead. Alright friends, after these calculations, the later part is going to be very simple, because you just have to compute bond equivalent yield. But here make sure discount yield was based on a 360-day year calculation, that is a year comprising of 360 days. But bond equivalent yield, when you are computing, you have to make your mindset very clear that a year is comprising of 365 days. That will be the convention that you follow. So bond equivalent yield at 6% discount yield means when the discount yield was 6%, what will be bond equivalent yield? Likewise, when the discount yield was 8%, what will be the connecting bond equivalent yield? So the calculation goes this way: F minus P1 divided by P1, because it is 6%, into 100 into 365 divided by days to maturity, You just have to substitute all these values. If you just compute this much, okay, it will give you the holding period yield, but we want to make the time adjustment so that we can compute the annualized yield, which will be bond equivalent yield, and it comes to 6.13%. So when the discount yield was 6%, the bond equivalent yield comes to 6.13%. Even in your suggested answers, if this is given as 360 days, do not follow that, please. Follow 365 days, which is the rightful thing. And in the same style, you are going to make the computation for the other one as well. I'll just expand the screen for you. So bond equivalent yield at 8% discount yield, computed in the same style, in the same manner. Just substitute the values of P2 over here. P2 was 990, and when you make the calculation, the time factor remains same, 365 divided by 45, and when you make this calculation, it comes to exactly 8.19%. Take note of this whole thing, and with that we put an end to this discussion. Thank you very much for attending this class.